Okay, this question is a question that maybe we don't answer in the way we initially think we're going to when we read the question. So let's read the question. Zipper Company invested $300,000 in a new machine to produce cones for the textile industry. Zipper's variable costs are 30% of the selling price, and its fixed costs are $600,000. Zipper has an effective income tax rate of 40%. The amount of sales required to earn an 8% after-tax return on its investment would be how much? Well, given the fact that we're told what our fixed costs are, we're told that we have a profit requirement, okay, we need to have an 8% after-tax return on its investment, this kind of leads us to think that this is going to be just a break-even question. And we've got our 8% after-tax return, we have our tax rate, we have our fixed costs, but the issue is that that 8% after-tax return is not a return on sales. Okay, when we look at break-even point and profit point, that percentage was generally a percentage of sales. And we don't know what the sales price is per unit. They tell us that the variable costs are 30% of the selling price, but we don't really have enough information to easily fit this into the break-even formula. Now, maybe we would be able to do it, but that's not the easiest way to approach this. What we first need to figure out is how much profit it is that they're looking for. Well, they have a $300,000 investment. That's what we're told. They invested $300,000 in this machine, and they want an 8% after-tax return. Okay, that 8% after-tax return is $24,000. But what we're calculating is, and when we put all these numbers into our formula, is we need to get the before-tax number. Okay, we did get that out of that break-even analysis. We need to know what the before-tax number is for this. So what we need to do is we need to take this $24,000 and divide it by 1 minus the tax rate. Okay, same thing that we did in break-even analysis. And this is going to give us a $40,000 before tax return. Okay, or $40,000 before taxes. Now, at this point, all we need to do is kind of think about how it is that we calculate profit. And we'll go ahead and recognize that we're looking for sales. And so we'll go ahead and make sales variable X. If we take our sales and we subtract variable costs, which in this case is 30% of the selling price, and we subtract our fixed costs, which they tell us are $600,000, that's our profit calculation, and we just calculated that it needs to be equal to $40,000. And so what we have here is just a very nice, simple algebraic formula that we need to solve for x. And so we get 0.7x is equal to $640,000. We divide both sides by 0.7, and x is going to be, and hopefully the number we get here is one of our choices, and that is $914,286, which fortunately that is for us one of the choices, so we know we did it right. Choice D. But this is just using the standard profit formula for the company. Sales minus variable costs minus fixed costs equals our profit. Now, the profit we calculate is before taxes, and so we just need to determine what that before tax profit requirement is, and then it becomes a simple solving for the variable in our calculation, in our formula that we set up to solve for sales. So you might want this to be a break-even point question using fixed costs, variable costs. It's part of it, but it's not quite the same, and so we're going to use a slightly different strategy, not a difficult strategy, but a slightly different strategy to answer this question.